You're
Sorry.
all right. Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man all the way from Philadelphia. There he is, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
You want to start with the disclaimer, which I think's up there for everyone to see.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, answer your questions. There's the disclaimer. And let me share my screen. So if you guys have any questions, you could put those questions in the live chat. Will's watching it. He'll read them back to me. If you want to come on the show and ask a question live, we also put out a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, click on raise your hand. There's a button. Click on that button. You don't have to turn on your video camera, but we will be able to hear you, but then you could ask your question directly. While we're waiting for questions to come in, what I'll do is start out looking at the pre-market report, take a look at what's moving in the pre-market hours, and then I'll navigate to SPY. We'll take a look at some insights from SPY. I think I started to take a look recently at volume, open interest. So there is a report there you guys can reference that kind of gives you a breakdown by different expiration months in SPY. So we'll take a look at that. If questions do come in, Will, stop me, let me know, and I'll take those questions. But hang on just 1 second, Will. I gotta close this. I have like some background noise from a window. Let me close it.
No worries.
Yeah, 1 sec.
And there he is. He's back.
Better. All right. So let's take a look at the pre-market report. And
actually, Rob just mentioned there was big news today. The unemployment came in very low, but the revision of economic activity shows the U.S. slowed down in the first part of the year. I'm assuming that unemployment being low is not what the Fed wants to see.
Right. They're looking for a small tick up in unemployment, just to have some evidence showing that they're slowing down the economy a little bit, slowing down that demand, because they keep referencing that labor market is very tight. If you have a tight labor market, that puts pressure on wage inflation, and of course, wage inflation very sticky, and they don't want to see that in the current environment. So in their battle with inflation, you're right, they don't want to see very low numbers in a tight labor market. And I do think that they were saying something, according to their analysis, there are 2 job openings for every 1 person looking. So very big imbalance, right? You would think that's a good thing, but for inflation, it's not, because that does create pressure on wage inflation. So if that's the number that you're talking about, Will, let me just look over my shoulder really quickly to see if I could. I'm not seeing it right now, but I know that number was coming out, and I think we have the PCE coming out. We've been talking about that. We talked about it yesterday. A couple Fed GDP, Fed talking. So a lot of numbers this week. Let's take a look at the pre-market report, Will, and then I'll move on to SPY. Did you have any follow-up questions?
No, it's interesting looking at your screen in the pre-market report. I think KMX is CarMax and Carvana. They're both down. Not that, I know the whole market's down a little bit this morning, but Yeah, no, it's still, I know the car market is still really tight. So if you're selling used cars, you'd think there'd be some margin in it, but
Right. Right. Well, they probably have difficult time also finding cars to put in their inventory, right? For them, their costs are going up too.
yeah, you're right.
So pre-market report, guys, these are stocks moving in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Here I see 53 stocks made our percentage gainers list, 205 on the decliners. So we are setting up right now with a bearish bias at the open. Yesterday we had a kind of decent rally. We'll see today. It doesn't look like it's followed through. In previous rallies, we've seen, that there was a big follow through where we've seen a rally followed by a couple of days of consecutive rally. Today, it doesn't look that way. We'll see how things pan out the rest of the day. But right now, we're looking like a weaker opening. Let's filter out this list to just S&P 500 stocks to get a sense of what's going on there. To do that, I'm going to filter out this list using these filters in ETF and drop it down. I'm going to select SPY, which is the S&P 500 ETF. And when I do that, the list below will get filtered by the holdings in the SPY ETF, which are S&P 500 constituents. And here we see 1 made our percentage gainers list, 42 on the decliners. So we are seeing that there's going to be pressure at the opening to the downside. And an interesting Apple, which has been holding up fairly well. Yesterday it was up, but even in this sell-off, it seems like that stock and Tesla actually have been doing relatively well. We'll see if that continues to hold, because yesterday they did have some kind of negative outlook or negative news regarding the sales of their new iPhones, right? So iPhone 14 just came out, and usually it's a big event for them. I don't think it's, I think there are people buying and there are lines, but the demand that they were hoping for to materialize, wasn't as robust as they were hoping. So yesterday that news came out, and Apple right now, if you look at it, it's not cheap. Those valuations right now are pretty high. Let's move on to SPY if we don't have questions, Will.
Perfect.
And we'll talk a little bit about, and I have been getting questions about SPY options with volume, open interest, and a little bit about implied volatilities, where they are. We went to a report over here under options activity. So this report here gives you a breakdown by expiration. So SPY, they has numerous expirations from options that expire in the very short term to options that are much more long dated. And I'll give you guys some insights from this report. We're talking about, let me see, where we're talking about volume and open interest before today. So let's take a look at the implied vols today and the straddle. That's what we'll do. Up here, this is kind of a summary here. This is the implied volatility IV30. The difference there is every expiration here. You can see this one expired yesterday, September 30th, October 3rd. SPY has a lot of expirations going all the way out to January 17, 2025. And if you go all the way here, this last column, it shows you how many trading days or business days are left for this expiring option. So October 10th, if I go here, eight trading days still left until that October 10th expiration. And down here, right next to each expiration, we have the at the money implied volatility. And you could see that these at the money implied volatilities are different for the different expirations. So you don't have one implied volatility going all the way through. That sometimes it could slope upwards, sometimes it could slope down. But as you see that they are different. So how do you come up with an implied volatility? Because when you hear usually stocks, implied vol's up, implied vol's down, that's what this 30-day IB is. That's using a constant maturity 30-day option. So it doesn't really exist. You have to interpolate it just like the VIX, and you do that from the surrounding options. So you have a benchmark. So here we see yesterday closed at 26.9. That's down 7%. How does that compare to historicals? Well, the median is 20.3. So if we took the last 252 days in trading days in 1 year, right in the middle, it's been 20.3. If we look at the low, 11.2, high 31.4. So you get a range here, the high and low, and then you get the median as well. This is yesterday's call volume, 4 million options in the calls versus 5.9 million in the puts. So about 50% more puts traded than calls. And that, I think, is kind of typical in SPY. Usually you do see more puts than calls trading in SPY. And here's the open interest, 7.9 million, almost 8 million in open interest in the calls versus 12.8 million in the puts. Then, so that's the implied volatilities here. We have the skew. I'll talk about that later. We talked about the volume and open interest. And then we have this at the money straddle. I don't think I covered that this much, so let's do that today. What is this saying? Here, for each expiration, we look at the at the money straddle, and then we interpolate, well, what is the cost and what is the implied move up or down to break even, okay? And what is that, the money straddle? Let me explain to people how we could look at it. When you and most people think of in terms of this way, if I think SPY is going up, right, 10%, let's say, or 20% in a year, well, what I'll do is I'll buy the stock, right? I'll buy the stock because I think it's going to be up 20% or up 10%, whatever it is, up 5% in a year. And that's enough for me. So I'll buy it. Other people think, well, I think it's going down 10%. So if you think it's going down 10%, you're going to want to short it, right? You could short it because you could play up or down. But what if you think that SPY will move around, but in 1 year, let's say in 1 year, you think it's going to be in the same spot, right? I don't think it's going to go up that much. I don't think it's going to go down that much. It's going to stay here or within a 3% range from here or 5%. I don't think it's going, maybe your assessment is earnings are going to be, they're not going to grow like they did before because interest rates are higher, and that's going to cap the growth. So based on my analysis, I think it doesn't have a lot to grow. And I think that we've already retreated enough that we don't have much downside. Wherever it moves around, this is where I think we're going to end up a year from now. So how do I benefit from that outlook, and what can I do? And we could turn to the options market if you have that outlook and say, well, what is the options market implying, and how much reward will they give me if I'm right? What do I stand to make if I'm right, and the stock does end up right here at 370 1 year from now. I'm willing to hold it for a year. I'm willing to take that volatility risk. I know some months we might be down, some months we might be up, but I don't think that the market is going to return that much this year, and I want a 5% cushion around. I think it's going to be within 5%. So let's take a look at what the option markets will reward you if you're right on that outlook, right? And that's where we could look at the straddle. So if we're right, and let's say it's exactly here at 370, right, in 1 year, let's take a look at this at the money straddle and what we stand to make. So I'm going to come down here and let's find an expiration that's 1 year away. So the closest one I see, and it's easier to find it here because 1 year is about 252 trading days. So this is the closest one, 242 trading days, right? That's about a year. So which expiration is that? That's the September 15th, 2023 expiration. So I'm going to come over here, and this is where the straddle is. So if we are correct and we sell the straddle, because that's our outlook, we think that that whatever premium we sell it for, the stock's going to be around here. If we sell that straddle and the stock is here, that straddle right now is around $75, which is 20% of the stock price, meaning the stock has 20% to move up or down to your break even. If it's exactly here, you keep that $75, which is 20% of this stock price. So that's the reward right now if you're correct, and you could hold on to that straddle. You could withstand that volatility. You don't think that in a year we're going to be, there's no way a year from now the market's going to be up more than 20%, and you don't think there's any way the market's going to be down more than 20%, because at that point, right, your straddle becomes unprofitable if it's to the downside and it finishes there. You're basically buying the stock down below 20%. If the stock moves up more than 20% and it finishes there, you get assigned on your calls, and you're basically shorting, unless you cover, you're shorting the market up 20%, right? So if you think a 20% could be enough cushion, especially if let's say your outlook is within 5%. Let's say you run your analysis, you run your models, and your best guess is that this is a fair value right now, and based on all your analysis, we're going to be within 5%. That the earnings can't get hit that hard in the next year, or they can't go up that much, so we're pretty much there. Then you're looking at 20%. If, of course, if the market's on the lower end of your estimated range, let's say down 5%, which is okay, right? Because you got a 20% cushion. So then you'll be fine. 10%, down 10%, you'll still be okay, or up 10%, you'll still be okay because you have a 20% cushion, right? So what is a 10% down? 10% down is half of the premium that you collected. 10% up, same thing. That's half of the premium you collected. So yeah, you have to buy back that straddle, but you're buying it back at a cheaper or at a discount to where you sold it. Now, that's holding it all the way. Of course, the other risks in play are implied volatilities. So you can also play it in a way where you think that right now implied volatilities are a little bit high. So if you go out here, you have a lot of vega, right? There's a big Vega, and if you're willing to hold it and thinking, that in the next month or in the next, let's say 2 months, you think that we're going to be peaking in volatility, that the market is not going to move too far away from here and implied vols will tick down, well, you will benefit from that as well, because what will happen is that the straddle premiums will start to deflate, right? So as Vega comes in, the further you go out, the bigger Vega you have in your position, right? Vega goes up as you go out further and further out in time. So even maybe you don't wait all the way to the end, but if you think that vols are going to come in, things are going to settle, and this is in the next month or two, or maybe we get one interest rate hike and then things kind of we reprice and things settle, then this also can benefit from Vega coming in, right? So that's another thing. Not that much decay, but obviously as you get closer and closer to expiration, those options will start to decay a little bit faster as well. So that's one way kind of to look at these numbers, the straddle. If your outlook is maybe the other way and you think, hey, in the next year, I think that we're going to be either down 50% or we're going to be up big, then the straddle may be too cheap, right? So if your outlook is, hey, you know what, no way, are these earnings going to hold? I think we're way overpriced. I think that the inflation is a much bigger problem, and our interest rates are going, up more than they're telecasting right now. Maybe we're at 5% and 6%. The housing market is going to roll over. If we're down 50%, then this looks like a buy, right? So it does depend on your outlook and your assessment of the data and information, but you can compare it to where the markets are pricing it in right now. And that's how you would look at these straddles and premiums. Okay. Does that make sense to people? Let me know if you have questions.
Yeah, no, that was super helpful. Rob was mentioning he didn't even know that opportunity existed to look at it this way. So that's great. We did have some questions from both Rob and Michael. I know it's getting close to the opening, so I don't know if you want to hit them today or tomorrow, but Rob asks, when you mentioned earlier Apple was expensive, what makes it expensive? What is the metric? Is it the 15 times earnings, 20 times earnings, etc.? How does that compare to the fair value estimate that we, I guess, create in the fundamental sections?
Right.
That was one question.
Right. So right now, and Apple for a long time was not priced like a big growth stock, big growth story, right? It had a low PE even as its earnings and revenue were growing. So from a historical perspective, like right here, let me see if I could go to the summary really quickly. So I don't have enough time, but we could see here, I'm just going to show you some of these metrics here. This right now, Apple is trading 42 times its book value. Now, Apple used to have a lot of cash on hand and used to, trade much closer to its book value. So you had some cushion if you were wrong. Here, it's all premium, right? This is all above right now, bid up way above its book value. Price to sales 6.4, P 24.8. And if we compare Apple's growth rates, it's been doing better than the S&P 500 for sure, on the revenue side. Net income little bit better. Operating income, yeah, better, but it's getting a much higher multiple here. And let's compare it to, like, say something, we'd have to compare it to other tech companies that are getting more mature. But I do believe, let me see, when I was comparing it, here's Microsoft, 10 times its book value, although it's much higher of its sales. What's Google? 5 times its book value, 4.7 times sale. I'm just looking at other companies that are a little bit more mature, maybe have a moat around them, are kind of similar situation. Also high earnings growth, in the tech space. But if you start looking at like Google, Microsoft, Apple, maybe even like Amazon, let me take a look. Maybe even like Amazon, which are technology, do have a moat, a lot of growth. To me, Apple seems like right now it is out of all of them, they definitely are priced as if they're going to grow, or they don't have as much cushion to the downside as these other companies do that are very similar. I mean, I don't know if Netflix really fits into that mold. We can take a look. Here's Netflix. Let's take a look at Meta. Has fallen off.
Meta's got it destroyed.
Yeah. So it's not, when I say it's expensive, it is not cheap, because what is the earnings yield here? Let me see. Here's the cash return, right? 4.4%. So think of it, cash return is if you bought Apple, if you bought the company outright and you paid off its debt and you got to keep all its earnings, right? All the earnings that it generated last year, you would return 4.4% on your cash, right? So that's not a high return if you, in my opinion, if you have the treasuries yielding just about that, right? So as far as the earnings yield, it's right in line with the treasuries. So that's one kind of metric I'm looking. And is it going to have this explosive earnings growth to make up for it? So you would maybe, if it has really quick earnings growth, then maybe it'll be worth it. But there's not a lot of cushion there, because if that earnings growth comes in, what if it flatlines? What if they're not growing as fast as they used to, or they have earnings going negative earnings, right? The earnings are going the other way. They're starting to not grow, flatline, maybe even come down a little bit. Then what is your cushion here? Because you're trading way above your book value, right? Your earnings yield is low, dividend yield is low. You're looking at a situation where you might maybe sit here for a long time. Maybe the stock doesn't go down. Maybe a lot of people like that stock. They could hold it up, but where's the room to go up? It has to come from very fast growth, in my opinion. And you're trading already at a high premium.
Yeah, and if you're worried about the market and the economy slowing down, it's going to affect all stocks, right? Actually, in that, we're right at 9:30, and unfortunately, we have a call we have to do at 9:30. Just a reminder. Yep. But that gets to Michael McCrae's question. We can either get it tomorrow or the next day. And Mike, you may want to email us, support@MarketChameleon.com. Let us know exactly what you want, but it's related to trying to find the beta of his watch list, if that's even a possibility. But let's get to that tomorrow. Great job, Dima.
All right. Thanks everyone for joining. Stay safe out there. Have a great trade.